Welcome back to Corporate Finance. Last time we talked about taxes and their impact on our dollar returns. This time I want to talk about inflation and its impact on our real returns or our consumption. Let's get started. Hey everybody, welcome back to Corporate Finance. So last time we introduced taxes and we explored the impact of taxes on our cost of capital, our discount rate, and our dollar investment returns. What I want to do today is I want to think about the impact of inflation on our returns and ultimately on our decision making. So let's get started. Okay. And I want to start with a picture, as I did with taxes, to illustrate the importance of inflation. This picture shows over the last approximately 110 years inflation in the United States. And what you can see is a couple things. First of all, over the recent period, inflation has been relatively low. But if you go back beyond, say, the last 30 years, you can see periods of really high inflation, including deflation. And so what I want to emphasize is that while inflation doesn't seem particularly important these days, it can be. And if we move outside of the US and some Western European countries, inflation becomes incredibly important. So let's understand it. How does inflation impact our returns in particular? All right, so let's revisit the example we've done over the last few lectures. Right? This example, just to refresh your memory, was, how much do we have to deposit or save today in an account earning 5% if we want to withdraw $100 every year over the next 4 years? And the answer to that question was $354.60. We deposit $354.60. That earns interest at 5%. That increases our balance. We withdraw the money. That reduces our balance, and we continue over the next 3 years until we drive the account balance down to zero. Exactly. Okay. Now, the first lesson is inflation is not going to affect the money we earn. It doesn't affect the interest over here. Right? We're still going to earn 5% every year, a nominal rate of return. Okay? What inflation is going to do is it's going to affect what we can buy with the money we're pulling out. Right? It's going to affect the value of that money. And so we'd like a way to quantify and understand the impact of inflation on that value. Okay? So I'm going to introduce the concept of a real discount rate, and I'm going to denote it by RR. And 1 plus the real discount rate equals 1 plus the nominal discount rate divided by 1 plus the expected rate of inflation, which I've denoted by pi. Okay. And a commonly used approximation that you'll see, though I'll emphasize this is an approximation, is that the real rate equals the nominal rate minus the expected rate of inflation. So in our example, we might have, right, our discount rate was 5%, and if expected inflation is 2.5%, which is approximately what it's been over the recent history in the US, we get a real rate of return on our investment of 2.44%, substantially lower. Now, that's important because even though the inflation is not impacting our account balance, how much money, how many dollars we have, it is impacting what we can do with that money, what we can buy with it. And that's ultimately what we care about it. So let's try discounting our cash flows now by the real rate of return, RR, which we just showed was equal to 2.44%, right? And the discounting proceeds mechanically in the exact same way as it was before, only now I'm using the real rate instead of the nominal rate. Okay? And if we do a little bit of arithmetic, we get the present values of all of these future cash flows, we add them up, and we get a value of $376.75. That's the present value of the sum of all these cash flows. Now, taxes affect dollars, but inflation does not affect dollars. It affects consumption. So we earn a nominal return, but we can't buy as much with it. Right? Let me illustrate this. Okay. So let's insert here into our savings account the $376.75 that we just computed using the real discount rate, and see what happens when we're withdrawing $100 every year. Well, that money is going to earn interest at 5%, okay, every year. Okay? We pull out $100, and what's going to happen is we're going to be left with this surplus. But that makes sense, right? Because inflation doesn't affect the dollars. It affects what we can do with these things that we pull out. Okay? See, we have extra money here. So what we really want to do to address inflation is we want to increase how much we pull out every year. Right? I don't want to pull out just $100 each year because prices are going up. So that $100, say here in year 2, can't buy as much food or housing or clothes or whatever we need to buy. Right? So let's think about what kind of cash flow stream we might want to address inflation. Okay. And one way to do that is to simply solve for the cash flows that we want to withdraw each year given a nominal discount rate R of 5%. What is CF? Okay. Well, we can solve this. This is just elementary algebra, right? Okay. And we want to use the nominal rate here since that's reflecting the dollars that we're earning. So solving this for CF, or cash flow, we get 106.25, which is greater than the 100. That makes sense. We're putting in more money at the beginning, right? Remember, originally I think we were putting in 354.60, if I remember correctly. So that we put in more, which means we can take out more than we used to take out. Right? And let's see what happens now. So we put in the 376.75. Now we're going to withdraw 106.25 each year. And we see that we're going to drive the account balance exactly to 0 with nothing left over. But ideally, we want our withdrawals to increase each year to accommodate inflation, right? I want these withdrawals to go up every year to account for the increase in prices of the goods that I'm going to purchase, goods and services that I'm going to purchase with that money. So let's think about this. Well, if prices are going up at 2.5% per year, that means what I could buy with $100 today, I'm going to need $102.50 next year because prices went up by 2.5%. They're going to go up by 2.5% again, so I'll need a little bit more, and a little bit more, and a little bit more each year. Right? See, what this sequence of withdrawals maintains our purchasing power. We'll be able to buy the same amount of food, the same amount of housing, go on the same vacations, assuming the prices are all going up by 2.5%, the expected rate of inflation. Okay? Now, these are all nominal values corresponding to the real $100 of purchasing power. And so if we take the present value of these nominal dollars at the nominal discount rate, we get the 376.75. We discount nominal cash flows by the nominal rate. Keep that in mind. It's important to emphasize that. The present value of nominal cash flows at the nominal discount rate, that's going to equal the present value of the real cash flows at the real rate, right? Remember that when we were withdrawing $100 each year, but we discounted these at the real rate of return, which I think was 2.44%, right? We got 376.75. And all that's going on is that the inflation term in the numerator and denominator of the real computation is they're canceling one another. Okay, so let's go back to our savings account. We insert the 376.75. We're now going to withdraw money that's growing at a rate of 2.5% per year to keep up with inflation, but our money in the account is earning the nominal rate of return of 5%. And what happens is we exactly exhaust our funds at the end of 4 years. And we've been able to do so by increasing our withdrawals each year to keep up with inflation. So let's summarize this. Inflation does not affect dollar returns. It's not affecting the money in the bank account or the rate at which it's growing. what it's affecting is the purchasing power of that money. So when I pull it out and go buy something, I can buy less of that good or that service with that same dollar year after year after year when we face inflation. So we introduced the idea of a real rate of return that takes into account the effects of inflation. Next time, we're going to turn to a new topic, interest rates. And we're going to build on what we've already learned to understand how to discount and value cash flow streams that don't happen every year, that are irregular in their timing, and how to deal with different compounding periods as opposed to annual compounding, which is what we've implicitly been doing all along thus far. So I look forward to seeing you next time. Thanks. Welcome back to Corporate Finance. Today we're going to turn to a new topic, interest rates, but before doing so, I want to briefly review our last topic, the time value of money. As you'll recall, we started off with some intuition, then we introduced the tools associated with the time value of money, namely the discount factor and the timeline. Then we applied those tools to move money back in time via discounting and forward in time via compounding. We discussed some useful shortcuts to compute the present value and the future value of cash flow streams that we commonly come across in practice, streams like an annuity and a perpetuity. And then we closed out the topic by talking about taxes and inflation and their impact on our dollar returns and our ability to consume goods and services. In this topic, interest rates, I want to start off by talking about interest rate quoting conventions, and I want to talk about how to compute the present value and future value of streams of cash flows when they arrive at irregular times, non-annual, and when the compounding is non-annual as well. So let's get started. Hi everyone, welcome back to Corporate Finance. Today we're going to be turning to a new topic, interest rates. But before doing so, I want to briefly review our first topic, time value of money. So we started off that topic by introducing the concept with some intuition. And what we did is we showed that cash or money received or paid at different points in time has a different time unit and as such can't be added, much like different currencies can't be added. Then we introduced the tools associated with the time value of money, namely a timeline, which is just a visual representation of when money is coming or going, and a discount factor, which is our exchange rate for time. It's what we used to move cash flows forward and backward in time. Then we use those tools to discount cash flows, that is, move them back in time, and compound cash flows, or move them forward in time. We introduced some useful shortcuts, namely the present value of an annuity formula and the present value of a perpetuity formula, as well as formulas for the present value of a growing annuity and a growing perpetuity. Then we closed off the topic with a discussion of taxes and inflation and investigated how those two concepts would impact both our dollar return and the purchasing power of those dollars. Now I want to turn to interest rates in this lecture, and this isn't so much a new topic as much as it is really an extension of the time value of money to incorporate institutional details and make things a little bit more realistic. So we're going to talk about interest rate quotes, and we're going to learn how to deal with cash flows that don't arrive once a year, but maybe arrive monthly or semi-annually. And we're also going to discuss how to deal with compounding of interest when it's not just annual. So let's get started. So here's a snapshot from December of 2014 of rates on 5-year jumbo CDs, where CD just stands for Certificate of Deposit. It's a savings vehicle that most banks offer, and here's 1, 2, 3, 4 banks. All right. Now, the jumbo, that just refers to, I think, a minimum deposit of $100,000. So these are big deposits. And one of the things you notice when looking at these rates, when you're looking at these savings vehicles, is that each one has two different rates. It has a rate and an APY, and these numbers, 2.37, 2.4, they're different. So that begs the question is, why are they different? How are they related? And most importantly, which one is going to tell me how much money I'm going to make when I invest in this product? Well, let's go through this, starting with the rate. The rate refers to the APR, or the annual percentage rate. That measures the amount of simple interest earned in a year. Simple interest is just the interest earned without compounding, ignoring compounding. And if you're wondering what compounding is, we're going to talk about it. But just as a preview, notice underneath rate, we have compounded daily. Okay? Simple interest ignores that compounding frequency. Okay? Now, many banks quote interest rates in terms of an APR. The problem is the APR is typically not what we're going to earn or what we're going to pay. For that, we have to turn to the APY, or the annual percentage yield, which is really just another way of saying EAR, or effective annual rate. See, the EAR, that measures the actual amount of interest earned or paid in a year. That's what we care about, the EAR. That's the number we care about. The rate, or the APR, that's just a quoting convention. Now, how are these different rates related? Well, before showing you the explicit mathematics, which frankly are almost trivial, let me emphasize the following. The EAR is a discount rate. The EAR is what matters for computing interest and discounting cash flows. The APR is not a discount rate. It's a means to an end. It's a quoting conventions. We're going to use APRs in conjunction with compounding frequency information to get at an EAR, or at a periodic discount rate, which I'll introduce in just a moment. So remember, EAR equals discount rate. APR equals quote. Now, how do we get from one to the other? How do we move from APR to EAR, or vice versa? Well, here's that simple mathematical formula I referred to just a moment ago. The EAR is related to the APR by this equality. Okay. Well, what's going on here? K, that's just the number of compounding periods per year. So imagine we had monthly compounding. That would imply a K of 12. How about semi-annual? That would imply a K of 2. And I'm going to introduce a little bit of notation here. I is the periodic interest rate, or the periodic discount rate, and that equals APR over K. Let's do an example. So imagine we're investing $100 in a CD offering 5% APR with semi-annual compounding. How much money will we have in 1 year? Okay. Well, there's actually two ways to approach this problem, and we're going to do each in turn. The first thing we always do, is we draw a timeline. And so today, period 0, we're going to invest $100. And the question's asking, how much money are we going to have in 1 year? Now, I've left this as a question mark to emphasize the fact that there are two ways to go about this. Let's go about this the first way. Go about answering this problem. Okay. The first is to work in periods. With semi-annual compounding, that means there are 2 periods per year. Since I'm interested in how much money I have after 1 year, that's after 2 periods. Okay. And these periods are every 6 months. Period 1, period 2. So if I'm going to work in periods, I better compute a periodic discount rate. That's I, which we know is APR over K, which in this case reduces to 2.5%. In other words, I'm going to earn 2.5%. I'm going to earn 2.5% over the first 6 months. Then I'm going to earn 2.5% over the next 6 months. Erase that. Okay. So I take my initial $100 investment, I multiply it by my periodic discount rate, and after 1 period, I've got $102.50. Then I repeat. I take that $102.50, I multiply it by my periodic discount rate to get $105 and a little over 6 cents. In other words, the future value 2 periods hence of $100 in this setting is just 100 times 1 plus I raised to the power 2. We're working in periods, so I is our discount rate, and 2 is the number of periods we're moving the money forward in time. Now let's approach the problem from the perspective of years. Now we're looking for how much money we have after 1 year. But if we're going to work in years, okay, now we need to be consistent. So after 6 months, this isn't one period, this is half a year. And because we're working in years, our discount rate isn't going to be the periodic interest rate I, it's going to be the EAR, the equivalent or the effective annual rate, which we know from earlier is just 1 plus the periodic rate raised to the number of compounding periods per year, so 1 plus I to the k, which in this setting comes out to 5.0625%. In other words, over this entire period, I'm going to earn 5.0625%, right, which turns out to equal $105.06, a little over 6 cents. That is, the future value 1 year from now of $100 is the $100 times 1 plus the EAR raised to the power 1. We're working in years, which gives me the exact same answer we got before, the $105.0625. So the lesson: if you discount cash flows using the EAR, then you better measure time in years. If you discount cash flows using the periodic interest rate, then you better measure time in periods. And the equality between the two that we just showed with our simple example is much more general and given by this straightforward proof, which I'm not going to discuss in detail, but I'll show you there if you're interested in looking at it. So just to summarize, we can work in periods, right? 1, 2, with a periodic interest rate, or we can work in years with our effective annual rate. Okay? And notice I measure everything consistently, periods versus years. Okay. So let's go back to our original example. Excuse me. We had an APR of 2.37%. We have a compounding frequency of daily, which I'm going to assume is 365 days, though you should be aware it could be 360 days or it could be 252 business days. It depends upon the convention used for that product by that institution. So these two pieces of information, the APR and K, allow me to compute the periodic rate I, which is 0.006741%. Now that's a tiny number, but we're computing interest every single day here. Which means the effective annual rate, which equals 1 plus I to the k, or which in this case is 1 plus 0.006714% raised to 365th power, gets me to just under 2.4%. So when we round the 2.398, we get about 2.4%. All right, so let's summarize. We learned that there are two discount rates depending on what units of time we want to work with. If we want to think in terms of periods, we want to use a periodic discount rate. That's I. If we want to work in years, we want to use the EAR, the effective annual rate, which relies on cash flows measured in years. Both of these are discount rates. They'll both get us to the same goal or the same end result, but we have to be consistent in terms of how we measure time with which discount rate we use. APR, that's a quoting convention. That's a means to an end. We use APR in conjunction with the compounding frequency to get our discount rate, whether it's the EAR or the periodic interest rate or the periodic discount rate I. And we can move between the APR and I and the EAR by a couple of very simple mathematical relations that we discussed. Now, next are a bunch of great problems that I want you to dive into. And then after you're done with those, move on to the second part of interest rates, in which we're going to investigate the term structure of interest rates and talk about the yield curve. Let you know what these things mean. Thanks so much. Welcome back to Corporate Finance. Last time we talked about interest rates. In particular, we talked about how interest rates are quoted versus how interest rates are used to discount cash flows. We also talked about how to deal with cash flow streams when the cash flows arrived more than once a year or less frequently than once a year, and when the compounding frequency wasn't annual. This time I want to talk about how interest rates or discount rates can vary over time and how that relationship is captured via a term structure of interest rates and a yield curve. Let's get started. Hi everybody, welcome back to Corporate Finance and our second lecture on interest rates. So last time we introduced the topic by talking about interest rate quotes versus discount rates, and we talked about an APR, annual percentage rate, which was a means of quoting interest rates that financial institutions often use. And that's often distinct from what we care about for discounting cash flows, which is an EAR, effective annual rate, or a periodic discount rate. And we talked about how to move between these concepts or these constructs, and then we showed how to apply them to non-annual cash flows and in situations where we have non-annual compounding, say monthly, semi-annual, whatever you might have. Today I want to talk about the term structure of interest rates and the yield curve. And this lecture is a little bit different in that it's not geared towards solving problems per se, at least not directly, because that's going to take us into a fixed income valuation, which is beyond the scope of this course. Rather, what it's going to do is it's going to be important to understand what these concepts are, because they're going to be used for corporate decision making later on. So let's get started. All right. Thus far, we've assumed discount rates are constant through time. They just don't change. And what do I mean by that? Well, if I look at my present value formula, right, I take my cash flows and I discount them by 1 plus the discount rate. But notice that's the same discount rate. It's the same number for every cash flow, regardless of when the cash flow arrives. Now, in reality, it seems as if interest rates vary with the term of the investment. Let me give you some examples. Here's a screenshot of home mortgage refinancing rates that I took not too long ago. And you can see that as the term of the mortgage refinancing varies, so too does the rate, or APR. And consequently, so does the EAR, the discount rate. Likewise, when I looked at fixed-term CD rates, where remember CDs are just certificates of deposits, their rates tend to vary with the term of the investment as well. And there's a lot of numbers here, so let me focus your attention here. Here we have the term of the investment, right? And here we have the APR and the EAR, right? And you can see that as the term increases or changes, so too do the interest rate. Now, what's the point here? Well, as the term of the investment changes, quite often, but not always, quite often, the interest rate will change. And the term structure is nothing more than the relation between the investment term and the interest rate. The yield curve is just a graph of that relation. So let me show you a Treasury yield curve from July 24th, 2014. On the horizontal axis, we have the maturity of the Treasury security. So here's a 1-month T-bill, right? Here's a 30-year T-bond. Here's a 5-year T-note. Okay? So these are just different Treasury securities that vary by maturity across the horizontal axis. And on the y-axis is the yield, which for the time being, and in this context, you can think of loosely as the discount rate, R. And the point is that as the maturity of the security varies, so too does the discount rate, right? In other words, when the government borrows for 30 years, it's getting paying an interest rate just above 3%, whereas when it's borrowing over a short horizon, say 30 days, it's paying basically 0. Now, let me come back to this notion of a yield and what a yield is. A yield, Y, is the one discount rate that when applied to the promised cash flows of the security recover the price of the security. And that is a mouthful. So let me actually show you a little formula that you're familiar with to hopefully clarify this. See, I take the price of the security on the last slide, the price of the T-bill, the price of the T-bond, And I lay out all of the promised cash flows to the security. I discount them back, and I ask, what is the discount rate such that when I discount these cash flows, I get the price? That is the yield, or yield to maturity. So to build the yield curve, that's just a matter of simply computing the yield for securities of different maturities. And so without getting into the institutional details and the semi-annual compounding and quoting conventions associated with treasuries, let me just talk conceptually. So if I want the 1 year the 1 year yield, I would just take this, say, cash flow at year 1, divide by 1 plus y1, set it equal to the current price, and solve for y. Okay. If I want the second yield, I would take the second security with maybe annual cash flows of CF1 and CF2, and I would solve for the 1 discount rate, y2 let's call it, such that when I discount these cash flows, CF1 and CF2, I get the price P2. And we do that for all different maturities. And the y's that come out, y1, y2, y3, all the way down to yt, that represents the yield curve. Those are the points on the yield curve. But that's the same as computing the discount rate for securities with different maturities, hence the link between discount rates and yields. Now, there is a difference between discount rates and yields having to do with promised versus expected cash flows, but that's a little bit outside the scope of the course, so let's leave that aside for now. And in the context of treasuries, yields and expected returns are relatively close. Now, one thing I want to emphasize is that yield curves, in other words, interest rates, they move around a lot, or at least they can. And so to illustrate that fact, I've plotted 3 yield curves here. The purple one is from 2012, the blue one is from 2000, and the red one is from 1981. And you can see that the rate at which the government was borrowing has varied dramatically over time. Right? Today, for short-term loans, they're not paying any interest. The interest rate's basically 0. But back in 1981, the interest rate was around 15%. Okay? The other thing I want to point out is that the relationship between the short end of the yield curve, short-term interest rate, and the long end of the yield curve, long-term interest rates, that can vary over time as well. Here, at least in 2012, we see that the curve is upward sloping so that interest rates, short-term loans to the government, are less costly than long-term loans. Whereas back in 1981, we see that long-term interest rates were actually below shorter-term interest rates, at least over a stretch here. So it was cheaper for the government to borrow at longer rates, or for longer terms at least, at a lower interest rate. Now, this raises the question, well, what does this mean? What does the upward sloping curve in 2012 mean as opposed to the downward sloping curve in 1981? Well, there's a lot of academic debate about that, but one popular opinion is that the slope reflects expectations of future interest rates. So when the yield curve is upward sloping as it is in 2012, this suggests that future interest rates are likely to be higher. Whereas back in 1981, this downward sloping portion, also actually in 2000 it looks slightly downward sloping as well, the downward sloping curve suggests that future interest rates are going to be lower. Treasury yield curves, what they're doing is they're graphing the relationship between interest rates on risk-free loans and loan maturity. So they have a very special meaning. When we talk about the risk-free rate, we're really talking about the interest rate or the yield on treasuries. Okay? But we can plot yield curves for a host of different securities, and that's what I've done on this next slide, is I've got 3 different yield curves. The blue curve is the yield curve for high-quality corporate debt. Right? So you can see that for, what do I mean by high quality? That's investment grade, think triple B or higher. Okay? So when high quality or highly credit rated firms were borrowing for, say, 29 years, it's costing them about 5% per annum, at least as of July 2014. Whereas when they're borrowing short term, say 2 years, it's a little over 1%. The green curve is the yield curve for municipal bonds, AAA rated municipal bonds as of July 2014. And then the red curve is the Treasury curve. And what's sort of interesting to note is that the yields or the cost of borrowing was higher, appears to be higher for the federal government over at least certain periods than it was for municipalities, which is strange if you think that our federal government is a much safer bet than a municipality, even a AAA rated municipality. But what's going on there is mostly a tax differential as well as some liquidity issues. Okay? All right. So what's the lesson here? Well, look, yields vary by maturity and risk. So to illustrate that point, I'm going to look at the yields on corporate bonds. And you can see as the ratings, credit rating improves from BBB to AAA, which is the best rating, okay, the yield goes down. And I know drawing the up arrow isn't helping, but the numbers are getting smaller. And they're getting smaller within each maturity bucket. Right? 1 to 2, 2 to 5, 5 to 10, 10 plus. Right? And that's a result of decreasing or credit risk. Right? These are safer bonds. These are safe. These are less safe, but still relatively safe. The other thing to notice is that within a credit rating, say AAA, the yields or the interest rates are different. Now, in this case, they're increasing, but as we showed a few slides ago, right, they don't always have to be increasing with maturity. They could be decreasing. Okay? The point is that they're different across the maturity spectrum. Now, all of these interest rates that we've discussed thus far are referred to as spot rates. And what are spot rates? They're the interest rate for a loan that's made today. Now, typically, there's a different spot rate for loans of different maturities and different risks. That's what we showed right here. These are spot rates. They vary by credit risk, and they vary by maturity. Okay. Now, what's one of the big punchlines or takeaways from all of this, aside from just general knowledge and information and understanding interest rates? Well, this present value formula that we've been working with is in many ways just an approximation, because we know interest rates vary over time. So it's really an approximation for this. Now, it's not such a bad approximation when the yield curve is flat. So when we have a yield curve, here's maturity, here's yield. When the yield curve is flat, R1, R2, R3 are the same. So these two things would be equal. The problem, let's see if I can erase some stuff here. The problem is when the yield curve is, say, upward sloping severely or even downward sloping. Now there's going to be a pretty big difference from using some sort of average discount rate R as a proxy for all of the different spot rates. Okay. So let's wrap up here. What did we talk about today? We talked about the term structure of interest rates, which captures the relation between interest rates and the investment term. Right? Loans or savings of different maturities, different terms, will often have different interest rates, and that relation is captured by the term structure. The yield curve simply graphs the term structure, right? It plots on the horizontal axis the maturity, on the vertical axis the yield or the interest rate, and that shows us the relationship between investment term and interest rate. We also learned that interest rates will vary by the risk of the investment, though we discussed that earlier on back in our first lecture. And we talked about spot rates, which are the interest rates for a loan that's made today. So, what's up next? We turn to a new topic, discounted cash flow. I look forward to seeing you then. Thanks a lot. Welcome back to Corporate Finance. This time we're going to turn to a new topic, discounted cash flow analysis. But before doing so, I want to briefly recap our last topic, interest rates. We started off discussing interest rate quotes and how they differed from the interest rates we use to discount cash flows. We then discussed how to discount cash flow streams when the cash flows arrived at frequencies other than annual and when the compounding of interest was something other than annual as well. We closed off the topic by discussing the term structure of interest rates and the yield curve, both of which summarize the relationship between interest rates and the term of the investment. Today we turn to discounted cash flow analysis, and I want to start the topic off by discussing how firms, or people more generally, should be making decisions. Let's get started. Hey everybody, welcome back to Corporate Finance. Today we're going to be shifting gears to a new topic, discounted cash flow analysis. But before doing so, I want to briefly recap our last topic, interest rates. So in that topic, we started off by introducing the notion of APR and EAR and a periodic discount rate. The difference being as follows, right? APRs, or annual percentage rates, are a means to quote interest rates, whereas EAR, effective annual rate, and the periodic interest rate are actually discount rates. They're economically relevant. They're what we care about. They're what we use to discount cash flows and make decisions. Then we use those discount rates to value and assess cash flow streams that were no longer arriving on an annual basis and to deal with the compounding of interest on a non-annual basis. Then we closed off the topic with a discussion of the term structure of interest rates, which is the relation between the interest rate and the term of the investment, or the duration of the investment. And we discussed yield curves, loosely how to construct them, what the yield means, where it comes from, and how to interpret these graphs. Now we're going to switch over to discounted cash flow analysis, and I want to start by motivating the topic and providing a little bit of background by discussing decision making. So let's get started. Let's start with a question. How should we make financial decisions? Well, a reasonable answer might be to undertake those actions that create value. Value for those affected by the decision, value for the owners of a firm, for example. But which actions create value? And well, that's a complicated question. A sort of general answer that seems reasonable would be to consider actions in which the benefits exceed the costs. But here's a little wrinkle. What if the costs and benefits arrive at different times? Well, actually, we're well equipped to deal with that wrinkle because we can compare the present value of the benefits to the present value of the costs. See, because by computing the present value, we know that the discount rate, R, will adjust both for the timing and the risk of the cash flows. So that brings us to our first lesson, which is that the NPV decision rule, that is NPV, which stands for net present value, NPV. The NPV decision rule says that we should accept all projects with a positive NPV and reject all projects with a negative NPV, where NPV is nothing more than the difference between the present value of the benefits and the present value of the costs. In other words, if the present value of the benefits is bigger than the present value of the costs, that's a good thing. That creates value, and we want to undertake that project or make that decision that leads to positive NPV. And while this formula right here looks somewhat vague and ambiguous, it's actually masking something that we're already very familiar with, and that's just discounted cash flows. NPV is nothing more than discounted cash flows, except now instead of cash flow CF, I have this F in front of all the cash flows. So it's FCF. The F simply stands for free. So these are free cash flows, but they're still just cash flows nonetheless. There's nothing special there. I'm going to formally define and discuss how to compute free cash flows in our next lecture, but for the time being, just recognize we're doing nothing new here. We're simply taking a stream of cash flows, FCF naught, FCF1 through FCFT, and we're discounting them back to today by a discount rate R to get a present value, a net present value. That's it. And so the decision rule just says if the NPV is greater than 0, accept the project. If the NPV is less than 0, reject the project. Reject the project. And while that seems fairly easy and straightforward, actually implementing it is quite a bit more subtle. And we're going to talk about those subtleties as we move along throughout this topic. So before moving on to some of the mechanics of a DCF analysis, I want to talk about decision-making in practice briefly, because it's useful to motivate it and to understand what people in different areas of both finance and non-financial sectors are doing when they're making decisions. So the first thing I want to look at is this, or show you, is this survey evidence from a survey by John Graham and Cam Harvey, former colleagues at Duke, in which they surveyed CFOs from the Fortune 500 and other U.S. domestic firms. And they asked them, how frequently do you use capital budgeting, different capital budgeting techniques? And what you can see is that there are actually a variety of responses. I've listed 6 here, but the majority or the predominant number of responses point to net present value and internal rate of return as the most popular decision criteria that CFOs use. That's followed somewhat closely by the payback rule and to a lesser extent the discounted payback rule. And in our discussion of DCF, while NPV is going to be center stage, we're actually going to spend a fair amount of time discussing all of these decision rules, because each one actually has important information for the decision-making process, though each one also has certain limitations that we need to understand. Now that's in the non-financial corporate sector. If we look at what investment bankers do when they are valuing companies in fairness opinions, you can see that the large majority of investment bankers are also relying on discounted cash flow analysis, something akin to NPV. But they're also using a host of comparables methods or relying on multiples. And while this is going to take us a little bit outside of the scope of our course, I might mention, if we have some time, how we use multiples in valuation exercises. If not, I might post some additional material. And finally, there's a recent survey by Paul Gomper, Steve Kaplan, and Vladimir Mukarliamov. I hope I'm not butchering that name too poorly. But they have a really interesting survey of private equity firms, and in which they investigate, among many things, which criterion PE investors use to evaluate an investment. And what's interesting here is the vast majority rely on internal rate of return by a wide margin over any other criterion. Okay. So let's summarize this. So we're going to move through this topic of DCF, discounted cash flow, emphasizing to a certain extent the NPV rule, because that is the optimal rule in terms of always leading you to making the decision that creates value. That said, I'm going to take a much more practical perspective to corporate decision-making or decision-making, financial decision-making more broadly, and recognize that other rules are still informative. They're still useful. And so it's not surprising that we see their use by practitioners, whether it's PE, private equity investors, or investment bankers, or CFOs. They're still informative, but the important thing to keep in mind is that these other rules have certain weaknesses that we need to understand, and we need to recognize the limitations of these rules so that we can use multiple rules in conjunction to come to the best decision. So what's next? We're going to dive into how to compute free cash flows, the first stage in understanding how to execute a DCF. So I look forward to seeing you in the next lecture. Thanks so much.